All right, we are live.
Are you gonna start the recording?
Let me see. I can start it on Zoom as a backup. There we go.
Okay. I think you guys are gonna like today's topic. We're gonna be talking about select funding, but we also now are gonna start talking. We're gonna talk to you a little bit about a new program that was opened up today. I haven't even had time to talk to David about it with one of our major, the number one lender on our platform, who is the A lender, that we usually probably 75% of all the fundings that we do with an A lender, we take through them. It's called retention pricing. And I'm going to talk to you about that in a minute. But first, I'm going to share my screen. Can you see that, Morgan?
I sure can.
All right. Let's start off today with, well, first of all, thank you for being here. I know your time is really valuable, and we've got a decent amount of folks on today. I'm just going to talk to you about some of the recent funding offers that we got through the select funding side of things, where, as you know, we try to keep the total annual cost under a 1.29. What that means is if someone's taking an 18 month or 2 year deal, it may be more than 129, but when you so do your math, it comes out to an annual rate of under that 129 or less. We just had a nail salon for 18 months. The sell rate's 139. What you do on this, though, and it's a 70,000, is if you take the 0.39 divided by 18 months and multiply it by 12, you come out to a 25.9% annual rate for the cost of funds. Plus, with this particular offer, if they pay this thing off, let's say not, if they pay it off early, they get a 25% discount. But let's say they're 9 months into it and they just want another 70,000. Guess what? We're going to waive the cost of funds for the rest of it, and they're going to be able to refi the balance and add another 70 to it and get an incredible rate. We had a transportation company. Some people don't think that we can get these kind of rates for transportation, but we were able to because they had their credit rate was closer in about the 770 mark. Excellent credit, beautiful volume coming in on a monthly basis, no little small daily account balances. They got no NSF, 3 years in business. I mean, this is a solid deal. And it came out to a 129. We had an insurance industry for 240,000. When you do your math on that over 24 months, that came out to 18.99 annual cost of funds. That's spectacular. And in a consulting company, 175,000, that came out to 22.66 annual rate for cost of funds. And again, that 129 rate is what we're talking about on most of these. And but when you get longer terms, you certainly can't have a 1.1899 over a 2 year period. They would lose money. They can't do that, and plus pay the commission and everything else. But this is what select funding is all about. But today, I spoke to our top lender, and they are loving us. And so they said, "Here's what we're going to do. We're going to offer you retention pricing for all your non-select retention pricing deals." In other words, if they fall under the select deal, they're already getting a fantastic deal. But what about those who we're not going to be able to give them that kind of pricing? They don't have that perfect credit, and maybe they don't qualify. So basically, what they're going to do now with us here at Bank Breezy, and I threw this together very quickly. They're going to let me buy down their rate. That's a whole lot different than just adding less points. Now, I'm going to have to take the buy down. I'm going to have to take those points off of our normal, 12, 13, whatever that is, 10. I'm going to have to take those off of that But what makes it better is instead of having a buy rate and then you're adding points to it, I'm going to have a buy rate even less than what they gave me. So I can look at it and say, oh man, I'm willing to take only 8 points or so on the deal, or whatever that number is, 50%, whatever the number is, and just to get that buy rate down by up to 6.5 points. And this is going to be a major deal. So now I can look at deals that are not select, and I can come out and give them with me having a buy rate of 6.5 less. And so what if we only take 8 points? It's only 2 points above what their normal buy rate. And by the way, these A lenders buy rates are way less than what the B, C, D lenders are. So this is really exciting. I mean, the commissions are going to be kind of like working with the select funding on deals like this. And this is not going to be on every deal because we don't have to do it on every deal. But if we're in a deal and we're in a competitive situation, rather than us taking our points off, we're going to take the buy rate down. And guess what? It works out the same, but the buy rate's way lower. So the actual price of this is going to be a lot lower as well. It's going to be lower than us taking our points off after we add them on versus taking the buy rate down by a bunch. And I'll get into more detail about this again, but this is a real good thing I just got. As you know, our select funding is anywhere from a 118 to a 129 annual cost of funds, which is so much different than a 130 to a 150 for our sale payments for repayment. I mean, this is really going to fast track our approval system. They got to be in business for 3 years, as you know, on Select. They got to have 100,000 in monthly revenue, 700 FICO. If they don't fit that, maybe they can fit the retention price, and if they don't fit that, then they can get regular pricing. Every week I tell you, continue in the construction industry. Get as many people in that, like plumbers, electricians, pavers, home builders, restaurants, anything in the retail market that's got a brick and mortar, or if it's got e-commerce, manufacturing, anything in the grocery industry, like convenience stores, grocery stores, gas stations, landscaping. This is the best time of the year to be dealing with landscapers because they got a lot of business going on. They're going to need more people to hire. They're going to need equipment being fixed because it's being used often. They're picking up new contracts. It's a beautiful thing right now to be out there looking at landscaping. Right down the road, you see someone out there mowing someone's lawn, stop and talk to them and see if they need any extra money. Childcare, nail and beauty salons. So that's really all I have for today. But I just wanted to let you guys know that we're getting some really good offers. And a couple of times these people are thinking in their mind, I'm sure that's not what the rep told them, or they're saying, oh, I think I heard they're going to get select funding is going to be like a bank rate. No, it's not. But bank rates are going up, and they're going up a ton. But these select funding deals, if you can go out and concentrate on them, you only need 1 or 2 of these a month to make your month. So do we have any questions about anything dealing with funding?
Christopher Sanchez has his hand up. You can go ahead and unmute yourself.
Wade, thank you for sharing your time. What exciting news. Briefly, can you go over both offerings again so I can better understand the distinction between the two? I'm pretty clear on select funding, but it's the one you just mentioned today.
Yep. Select funding, as you know, like I said, is these are the ones that have this 3 years in business, 100,000 and 700 plus credit. But you're going to have a lot of companies, Chris, that aren't going to be able to fall into that category, but they still qualify for an A funding offer. In other words, they're going to get a better offer than if we went to a B or C or D funder. So This is one where I can't get a buy rate low enough because of them not qualifying. They may not have a 7, they may have been in business 2 years, or they may not have the volume on the daily balances and that sort of thing. So they don't qualify for select, but they do qualify for an A paper funding. So now I can take those and I can do retention pricing, which is pretty much like select almost, where I can drop the cost of funds all the way down to about 6. If I agree not to take full commission and I take 50 or 60 or 70% of the commission, then they're gonna work with me anywhere from 2.5 to 6.5 points off of the cost of funds.
So does our
And
commission go from 2 to 4 then?
no, your commitment, no. This has nothing to do with 2 to 4 to you guys. It has to do with the percentage of points that we're taking off, and then the percentage of points may be, you may, if I have to do, if it takes retention pricing to get the deal closed, in other words, they're not going to do it where it is right now. But if I can get 6.5 points off and you can get 60 to 70% of your commission versus 0, that's what this is about.
This is just, yeah, unbelievable. Thank you so much for everything you're doing, Wade.
Hey, and I'm gonna get more details out to you. I just got it sent to me 30 minutes before this call. I got off of another conference call with them, and they're not doing this with everybody, but they are giving us retention pricing because of our stability in the marketplace, and for I guess you would say the fact that our default rate is almost 0 with them.
All right, we've got Jonathan C. You can go ahead and unmute yourself.
Hello, can you hear me?
Hey, I can.
Hi, thank you for meeting with us today. I'm glad to get started. Recently have joined DAC as an affiliate, and am here to learn more about this business funding side, because I think that's the opportunity I'd like to lead with. So thank you for the information, but I do have a couple questions. So I'm a little new to funding. Is the buy rate the percentage that you were mentioning, like that 1.18 to 1.39?
No, the 1 point, we've got buy rates can be all over the board. The buy rate can be a 1.18, or it can be a 1.30 or 1.40. It can be that if it's a terrible file.
So
So
what is the buy rate? I'm not
well, there
familiar
is
with
no
that
such
term.
thing. A buy rate is what we pay for what they're letting us buy the funding pricing for. Then we got to add our commission onto it.
So
And
it's what they're letting us buy the funding for? Is that what you said? You said the buy rate is what they're letting us buy.
These banks that we're dealing with, they got to make a living. So they're going to say, okay, here's what we got to make on the deal. All the rest of the points that you add to this to sell it is going to be your commission. And we've got a standard amount that we use. And now they're going to allow us to take that buy rate and buy it down. And it's a big deal. What I suggest you do is go into the back office and read up on all things funding, because it will talk about all this.
And I did watch the funding training video there in the resources. But also the underwriters call right after they fill out the application, right? Like
No,
they get a
underwriters
call
don't.
after they fill out the application?
No. Underwriters don't call. Our team calls. Underwriters
okay.
only deal with us. The client's never going to deal with an underwriter. They're going to deal with us. But our team does initial underwriting on the file. We look at it and we say, okay, this and this and this is true about this file. So here are the lenders that will fall in the category that they need to, that this file needs to be looked at. Or we'll say, hey, there's 9 negative bank days for the month. We're not sending it to anyone. It's going to be declined. So we kill the deal right there.
Oh, okay. That
So
makes
we do
sense.
in-house underwriting before we send it to the lenders, our partners.
All right. So basically the cost of funds is based on the buy rate, and the underwriters, like we have the initial contact, and the underwriters handle the differences between selecting the deals, right? For which lender they go with, right?
The underwriters decide whether they even want to make an offer, and then we look at we're going to get maybe anywhere from 2 offers to 15 offers, and we're going to look at the best 1 or 2 offers, and that's what we're going to present.
Okay, so, but our job as affiliates is just to find the businesses that want some extra funding to help grow their business, and then send them our link, and then y'all take it from there.
Absolutely. You shouldn't even be getting in, and I'm just letting
It's
you
just
know.
details for us.
Yeah, I'm just giving you details on how we're going to win the business with your clients, because you're not going to get involved in any of this. I'm just letting you know we got a lot of options now.
Cool. Well, thank you. Those are
Thank
my
you, Johnson.
questions.
Appreciate it, man. Hey, thank you.
Bye-bye.
Congratulations for coming on board.
All right, we've got Janet Skeels. You can go ahead and unmute yourself.
Hey Wade, can you hear me? No, you
I
can't.
can.
Oh, okay. So I'm still trying to figure out how to help these, especially the restaurants after the hurricane. So will this buy rate be able to help them? They were down for like anywhere from 3 to 8 days and had to throw away a lot of food. But if they had the revenue before that,
If they're
And-
if they're back up, Janet, I've talked to underwriters about this. If they don't have the revenue to pay for a large amount of funding today, they need to wait 30 days. And so what underwriters are going to do is they're going to look at it on this situation. They got to be back up and running. They can't
Right.
not be back up and running. And they'll look at the last 12 months of bank statements, and that's how we can help them. Because if you look at what they've done and they just started back, we understand that they're not going to be they're going to have a revenue slip in that period of time. But saying all that, if they're not in full capacity, then that's going to affect what they can get money for. I mean, the amount of money that they can get, and nobody's going to say, okay, for the last 12 months, they're doing that. And then right now they're like 1/3 for the month. Cause I know they just opened up, but they're 1/3. If they had opened up within the last week, it's going to be tough to get anybody to underwrite it. They want to make sure they're really open, so they need to wait 30 days. And but that's it's just such a high risk industry anyway. Nobody's going to overlook the fact that they're not making as much revenue right now. But if they start back and they're making just or close to the same amount, I'm going to be able to help them.
okay, because like I said, they were down for like 3 to 8 days. Most of them are back up and running now, but they just need that money to like buy all the food they had to throw away and
Right.
blah, blah, blah.
But if they were down 3 to 8 days instead of 3 to 8 weeks, because I got a lot of friends of mine. Well, I got 2 especially that live in the Woodlands, and I saw them just because they have a home here in my neighborhood as well, and they came here and they were telling us that Woodlands even got affected by it. But I know downtown Houston was a disaster area for a while.
Yeah, well, I am in the Woodlands, so yeah, ours was, like I said, 3 to 8 days. It wasn't as bad as downtown.
Right. That's how we can help
Okay.
them.
All
Thank
right,
you.
thank you.
All right, we have Pamela W. You can go ahead and unmute yourself. I'll ask you to unmute one more time.
Okay, can you hear me now?
I can.
Okay, hey, wait, I just want to clarify just a couple things. First of all, these are still going to be weekly payments. There's not going to be any options for monthly.
No, there's not going to be an option ever. There's one company in the industry that's doing monthly, but I mean, you got to give your next of kin, your next baby to them to even get approved. And so it's really a bait and switch to get people to apply. And so it's going to still stay daily or weekly payments.
Okay. And then the other question is on the FICO score. You're saying 700 for their FICO score. I know that, sometimes those can vary between, different bureaus, sometimes 20, 25, points.
Well, they're looking at Experian, just so you know, Pamela. Experian is one that the majority of the A lenders look at.
Okay.
And I'm talking about even, and when they look at everything, they look at the revenue, they look at everything, they may be there, they may fall into the select pricing or they may not, but they still would get an A lender offer. I'm just saying now that they get an A lender offer, if we're still not where those people want, I have access to retention pricing to get that thing lower.
Okay, that's what I need to know. Thank you.
But I'm only going to do that if we're in a competitive situation, because I'm not trying to gouge them, but I want to get full commission. It's important that we look at the brokers too. We want to get full commission as much as possible for the broker, which is you guys.
Right. Okay, that's what I just wanted to clarify, because they're always begging to be able to get a monthly payment, and I tell them that's not existing here in this industry. Just wanted to confirm with this new program. So
Yep.
That's all I need.
Thank you.
All right, thank you.
All right, next we have John Arthur Moore. You can go ahead and unmute yourself.
Yeah, can you hear me?
Yes, sir.
I just wanted to know, give an example of that. You said insurance industry in one of your slides.
Right.
Give an example of that.
Well, listen, insurance agency that has let's say an independent that has a book of business at PNC, or an insurance adjuster, or an insurance agency that underwrites I don't know, whatever, anything in the insurance industry. It can be an agency itself, it can be an adjuster, it can be an insurance broker, it could be a lot of many things in insurance. This happened to be an adjuster.
Okay, thanks.
You're welcome.
All right, we've got Ralph J. You can go ahead and unmute yourself.
Hi, Wade.
Hey,
My question is regarding NSFs. How many can a business have before Bank Breezy turns them down? Number one, and number two, let's say they do have somewhat of an excessive amount of NSFs, but their monthly, income or what they're depositing into the bank accounts is pretty high, 60, 70,000 a month, let's just say, for example. Is that, excuse me, is that taken into consideration at all, or how would that scenario play out?
let me talk to you about two things: NSF versus negative bank days. The first thing we look at is negative bank days. If you're 6 or more, I don't care if you're doing $1 million a month, nobody's going to take you, because that means you're almost 30%. Well, you are 30% of the month is negative, and that they're not going to be able to collect their money. So when you look at it in the last 3 months, if any of those months have 6 or more negative days, it's going to be a problem. If they end the month in a negative but it's only been 1 or 2 of those, that's not so bad. That's going to keep them from getting any kind of select pricing for sure, but it doesn't mean they're not going to get funded. You can have one day where you had let's say you had an $11,000 a check that was given to you by your client, it bounced, and that made 30 checks bounce. They're not going to worry about that. But if you got 30 and 40 NSFs throughout the month and you got $35 tagged onto it the whole time, that comes in consideration. The big thing is really how many negative bank days are there. 5 or more is unacceptable, really. Sometimes we can get 5 to slide, but it needs to be 4 or under for the whole month.
Okay. All right. Very good. And then when clients do turn in bank statements, I know it's 3 months, correct?
Not in every state. We let them know. Some states, there's about 18 states that require 4. The new disclosure laws require 4 months of bank statements.
Okay. I'm in California, so would it be 4?
4 months. Yep, it'll be
Okay.
4.
Do they take an average of what that looks like for all 4, and they take an average, or is it just the lowest month out of the 4, and that's what they base the loan on, or the
Well,
funding?
it's a yes. This is a yes and no answer. In cases where the credit's an issue, they're not going to give more than the worst month that you had there on your first initial funding, and then maybe 45 days later get you more. If your credit's really good, you got a great industry like restaurants or what have you, or construction, and you just had a bad month, then they'll take the averages. The people who don't take the averages are the C and D lenders who, this is already a high risk deal because there's a reason they're having to use C and D. So they're going to probably more likely take in consideration and take the lowest couple of months and kind of average those lowest 2 months versus looking at it and saying, hey, this is one bad month, we're going to throw that out. They're not going to do that. A lenders, they don't look at it that way because people have situations where maybe a check didn't get there, or they're getting paid by the government if they're in the healthcare and that check just didn't get there. That happens all the time.
Gotcha. Okay, thank you.
You're welcome.
Right, next we've got Matt DeHame. You can go ahead and unmute yourself. And then we've got 2 questions after.
Okay.
Hey, Wade. So
Hey.
first question real quick. Okay. So recent offers. I'm thinking about my agent, Michael, with his client you know well about. Maybe we can go back to him. How about going back to client I just got a 1.43 for, and going
Well,
back.
they don't qualify for retention pricing
Okay.
only because of their credit. That I know the one you're talking about, and it's not what they said it is. I got a copy of what it is.
Got it. It's had and what's the criteria for credit or FICO for this?
Well, any A lender is going to be about 675 and
680.
above.
Okay.
Yeah.
So this is kind of okay. So coincides, because I heard you say it goes. I thought it was a B paper. I guess I missed that. So
Yeah.
It's not really the select funding. This is the second tier of that in the same spirit of it. But
Exactly.
they could be
Well
doing
said.
50 grand. Yeah.
Well
They'd be doing
said.
50 grand a month. They don't have to be doing the 100 minimum. They could be in business for 2 years instead of 3, in other words, right? But as
Correct.
long as their FICO score is 680 or higher, we're good to go.
Yep,
Is that fair enough? Okay.
Yep.
Yeah. And second question is they're paying basically our partner, the provider, A paper, is giving you, Big Breezy, let's say 2 points less, or 2 or 3. You're saying that's only going to drop, for example, or in other words, if we buy it down by 6.5%, the full amount, drop a deal from 1.43 and offer it to the client for 1.3675. They're paying us 2 or 3%
The way
less
they would do it's not going to be working in a mathematical thing. What they do is they say, I'm going to drop it down this many points, and you max out commissions at up to 8 points. That's what you're going to max out commissions to. So the reason it's so much better is they're not going to give you but a certain amount of commission, and on any kind of deal like that. And 8 is the highest, 5 is the lowest.
Yeah. Okay. So the question, that's last question I'm going to jump is, whose discretion? Are you going to contact the agent and say, hey, we could do this? Would you like to cut your commission, or are you just going to do it arbitrarily to save a deal?
If I have to save the deal, I'm gonna just do it. And if they, I'm not gonna make that offer unless the deal's not gonna be accepted. I'm gonna make a full commission offer all the time, every time I can possibly do that. And then I got a backup plan if I have to, because it looks like we're doing something for them that and again, I want to give them the best offer out there, but I still, there's a balance here. We want the commissions to be full commission for the agents, and that's the number one priority. But if I can't close it, and when I say close is the wrong word, if we can't have them feel comfortable enough to move forward with the funding, then I'm going to have to do whatever I have to do to get it done. And I'm going to start with just a couple of points, and try to keep that at least where we're getting 70% commission.
So if they don't accept the offer, you can go sweeten the deal as a last resort. That's what you're saying, right?
Right. And before we sweeten the deal by taking our points off, but the buy rate works out better. It doesn't sound like it would, but it really does work out better.
Perfect. All right, great. Thank you, man. Thank you, my friend.
All right. Next up, we've got Christopher Sanchez, unless your hand is still up by mistake, but I will ask to unmute you just in case.
Wade, real quick, and forgive me if you had answered this question in the past. Is it beneficial to have a discussion with brokers now? Especially since we have these two options with select funding available. And when I say brokers, I mean independent brokers who are out there. They don't work, so to speak, obligated to one agency.
Well, you know, I'm not sure. I'm really not sure what I think what you're asking me is getting experienced people in the industry that already have contracts. Is that advantageous? I say yes, because they're not going to be able to, I guarantee you they're not getting this kind of pricing.
No, forgive me. I meant in regards to having them become an affiliate with David Allen Capital.
No, I know what you mean. You're talking about people that are already in the industry, right?
Yes.
I would say absolutely give them an opportunity to be able, because they're not going to be getting the same pricing we're getting. I can promise you.
Awesome. Thank you so much, Wade.
You're welcome.
All right, just two more hands up. We've got Eddie and then iPhone. Eddie H, you can go ahead and unmute yourself.
Hey Wade, real quick regarding franchises, are we able to offer them funding? And if so, like,
we funded. Oh, I'm sorry. Let me shut up and let you ask me that question again. I'm sorry. I'm jumping the gun. Well, I think what you asked me, if we can fund franchises, we can fund them all day long. But I'm going to tell you, in the franchise world, there are restrictions that they have on taking money in a lot of cases. It just depends on what their contract says with their franchisor. And I can, as a franchisee, you got certain obligations that you, for example, if I was a franchisee of Chick-fil-A, I can't go borrow money and put my company out there. I just can't do it. They won't let me have it against that company. I would have to pretty much get my contract out, look over it, and see what I can and can't do. We can help those folks, but it's not going to be all the time. Do we have anybody else?
We've got one more. iPhone, go ahead and unmute yourself. Last question of the call.
Hey, Wade, thanks for coming out tonight. Hey, I may have missed this answer. Where do we stand as far as the cannabis industry? Can they now?
Yeah, we got a couple that would do cannabis, but you got to be doing a lot of volume. I mean, they want it now. They want it up close to $250,000 a month, so they know you're going to stay in business.
Okay.
And so, I mean, if you got something over 100,000, submit it. I'll see if I can get it done. Okay. It's just they're just really, these lenders are really nervous about that industry. And quite frankly, there are a lot of funding opportunities out in the cannabis industry with groups that aren't doing the type of funding that we're doing. They're doing more like monthly payments, and they got collateral involved, and they want to have assets. So it's just, we don't want to do that. So we're gonna keep it simple.
Okay. All right. Thanks.
Thanks.
Okay, Wade, how are you doing on time? I know we try to keep to 30 minutes.
I'm good. I've got till 12:30.
Okay. So we have just two hands pop up here. Domino, you can go ahead and unmute yourself.
Hi, Wade.
Hi.
I was just asking, if for a client that has like other loans in place, do you deduct their payments if they can still qualify for funding?
The way that works is if you got 1, 2, 3, however many positions you got, when we're deciding what we're going to offer you, we're going to look at two things. Number one, if it's a lender or a B lender, they may want to buy those things out and get rid of them. Matter of fact, if you're an A lender, they're going to 100% buy it out because they're not going to take a second position. But if they already have those and they got a certain amount of money that's coming out of their daily or weekly, then that is part of the consideration when you're getting an offer. For example, if you would normally have gotten a $25,000 offer because they didn't have any other positions, but now you see that they got one or two other positions, that could drop that thing down to $10,000 or maybe less, maybe a little more, because they do take in consideration what can they afford. They've got a ratio of debt to income that they look at in this industry, and they say, okay, if they're over 35% of their revenue every week or day is going out toward these, then they're not going to qualify because they got to have something to run the business on themselves. So that's how it works.
All right, and last question, Jay Williams. You can go ahead and unmute yourself.
Wait, can you hear me?
I can.
Okay. A couple questions. I came in late on your insurance. I'm a retired insurance agent, more from the captive side. And to your point, that's where so oftentimes, whether it be even in the captive side, the early years, and most of the time they get vetted by their particular insurer to make sure that they've got the proper assets to survive in the business. And then it comes into whether or not they can meet the sales quotas. But on the independent side, I see a great need, and I've networked a lot in that area. And so again, if you could go over a little bit of what you talked about on the insurance side. And then a follow-up question is that I also, kind of a twofold, is that I also, when I was in the independent side, I worked a lot in the senior care industry. And again, the senior care industry, whether it be home care to assisted living, they too, again, struggle with funding a lot of times, for payroll, but a variety of different reasons. And again, most of these have been in business for a significant amount of years. And then lastly, also what I see, what I subscribe to here locally is, and it's throughout the country, but certain businesses that didn't file correctly, and again, going back to the insurance side, especially with contractors, what they would do as a general contractor, they would forget to pull the certificates on their subs, and then all of a sudden, when they had their audit, they have to come up with, they didn't get the proper certification. So long and short, they have a payroll or a tax levied on them. Do you guys do much funding in the tax side, whether it be improper filings with the both at the federal and state level? Do you guys give funding in that area?
Okay, that's a bunch, so don't hang up.
Sorry about that.
All right, let's start out with the last question first. Yeah, we fund all the time businesses that have tax levies, liens from the state or the county or the feds. What our normal course of business is, we look at it. If it's under 50,000, that usually is not an issue. If it's above that, they got to be on a payment plan, and we'll still fund. If they haven't filed taxes in 3 or 4 or 5 years, it's going to be hard to get funding. They'll probably get small funding, but they're not going to get the A lenders to fund if they find out that there's already a tax lien out there, because they can come and snatch the business anytime they want. They are really good at working with people, I found, but in the lending space, I think I just answered that. Those are the kind of things that we look at if we're going to give them money. By the way, if you're an insurance agent, this is a great time to be getting involved, because you already got a book of business. You already got people that you run into out there, and Jay, you're going to be able to help them get funding that you didn't even know was available. So that's a built-in clientele, I think. So if I were me, I'd be recruiting nothing but insurance agents. Going back to the insurance industry itself as a whole, can you tell me what you asked me on the first question about insurance industry, about the types of business insurance agencies?
Yeah, again, what I have found, or some of the challenges, is that when typically, they've been in business. Again, more it's on the independent side, because the captive side, the insurers pretty much vet to make sure that they can survive the first, 5 years in the business, that they have enough collateral or whatever. But on the independent side, that's what happens, is that if a person gets rejected from a captive insurer, they then start their own independent agency, and again, 3-5 years, and they think they want to, stay in the business, but they don't have enough funding or enough capital to survive.
It's a very, I think captive insurance agents are going to be a dinosaur here one day. I know that I would never be in that industry as a captive agent, but a lot of folks are, and I applaud them. But going back to your answer, the insurance agents that I'm talking about in agencies are adjusters, large agencies that have a lot of agents, or an independent person out there that's got commissions coming in excess of $3,000 a month from their. If they can still be a gig, they can get gig working funding, but if they're doing 15,000 and higher in commissions monthly, then we're going to be able to get them funded. But we're going to be able to get them funded based on a couple criteria. Number one, that they're consistently getting that revenue in. Number two, that they are getting at least 3 deposits or more a month, and then they don't have a lot of NSFs. They don't have a lot of real small balances. But we can still
That's a
fund
good
them.
question. And so again, to that point, let's say, there's an agency that has 5 to 10 producers, and, I got a good relationship with the agency, and then he or she wants to get some gig funding for one of those young producers that, just need a little funding to hopefully get them over the hill to, produce in greater quantities for them. Is that a viable candidate, or would we work through the agency, or would they go down to should I build a relationship with the independent producers and agents?
Well, if the producers are the one that want the money, they got to be doing 3,000 a month in revenue. And in the agency, if they want it, they need to be doing 15,000 a month in revenue, so they can get the bigger, better funding opportunities. So it depends on what, an agency is not going to get funding for a local insurance guy. And quite frankly, these are not, if you're not going to get funding and use it to build your business, and if you're doing it on a survival method, that we're not the right place for you. And if you're an independent insurance agent out there and you're just trying to survive and you need upfront money, we're not what you need for marketing, for leads, for that sort of thing. Then it's a good, viable option for you.
Okay, good. Thank you very much for that.
Yep. And I think that's everybody, Morgan. Listen, appreciate you guys. I hope you have a great rest of the week and a lovely weekend. And I'll be talking to you again in a week.